Hello friends, welcome to my channel Sultan Technical. Today our topic is mortgage loan in USA. Where did mortgages come from? What makes mortgages different from other loans? Should you apply for a mortgage? Today we are telling you everything you have ever wanted to know about the history of mortgage. Early history of mortgage. The modern mortgage has only been around since the 1930s, but the idea of a mortgage has been around for a lot longer. First, it's important to talk about the meaning of the word mortgage. To understand the word, we need to break it down into two separate Latin words, mort and gage. Mort means death and gage means pledge. A mortgage is a debt pledge. Don't let that scare you. The debt part of mortgage does not refer to you or any other person. Instead, it refers to the idea that the pledge dies once the loan was repaid, and also the idea that the property was dead for or forfeit if the loan was not repaid. Mortgages are mentioned in English common law documents that date back as far as 1190. These documents illustrate the beginnings of a basic mortgage system. They describe how a creditor is protected in property purchase agreements. Specifically, a mortgage was conditional sale where the creditor held the title to the property, while the debtor could sell that property in order to recover the money paid. Essentially, a mortgage is a loan secured by a property. Most people don't have the liquid capital required to purchase a house entirely on its own, and mortgages help these people purchase homes and properties. The first mortgage in America. The idea of a mortgage started in England and moved throughout the Western world from 1190 onward. In the late 18th and early 19th, America waves of immigrants increased the need for mortgages and affordable property. Unfortunately, mortgages at the turn of the century were different from mortgages today. In the early 90s, home buyers typically had to pay a 50% down payment with a 5-year amortization period. This meant that those who bought a house or property typically already had a lot of money. If you were buying a $1 lakh house, you would have to pay $50,000 and pay off the remaining $50,000 within 5 years. Increasing the likelihood of default was the fact that mortgages were structured completely differently than modern mortgages. On a 5-year mortgage, home buyers would pay interest-only payments for the 5-year term. At the end of 5 years, they would face a balloon payment with the entire principal of the loan. This system was not perfect, but it did provide homes and properties to millions of Americans. However, once the Great Depression hit, mortgages would never be the same again. During the Great Depression, lenders had no money to lend. Of course, borrowers did not have any money to pay for the hard-to-find loans either. The Great Depression and New Deal. Roosevelt's New Deal may have made America what it is today. The New Deal included a number of important regulations that made America a more consumer-friendly nation. The New Deal was designed to stimulate consumer spending and promote economic growth. At the same time, the banking and financial industries would face more scrutiny and regulations. The Federal Housing Administration (FHA) was created in 1934. and was built to protect lenders and reduce lending risk, since lenders had become extremely cautious about lending since the Great Depression. This was severely hindering economic growth. The FHA solved this by protecting lenders and substantially reducing the risk of a borrower defaulting on a loan. To do that, the FHA created a number of valuable mortgage services. They created the 30-year mortgage, for example, and reduced the down payment required on new home sales. The FHA also created an appraisal system that helped lenders assess the risk in a certain property. The 8-part appraisal system includes indicators like protection from adverse influences, and relative economic stability. Loans that met the FHA's standards of approval were loans as FHA insured loans. There were also a number of neighborhoods built across the country known as FHA insured neighborhoods, which facilitated the mortgage process for new home buyers and encouraged lending activity. Ultimately, the FHA created the modern American mortgage by adding the following systems: quality standards. In order to qualify for an FHA insured loan, a home had to meet certain quality standards. These standards measured the home's likeliness to hold its value over time. Homes which were more likely to hold their value were more likely to receive an FHA insured loan. Lower down payment required. The FHA started a program that offering 80% to 90% loan to value LTV, 15-year to 30-year loans. Amortization periods. These are the some modern American mortgage. 1938 and the creation of Fannie Mae. Fannie Mae is the nickname for Federal National Mortgage Association. The FNMA was created in 1938 in order to increase the amount of money available to borrowers using mortgage securitization. These are the mortgage. Subscribe our channel and like. Thanks.